finance, a la shmup. What is an aggressive growth fund, a go-go fund, and/or a high-octane fund? Ah yes, investment funds have oh so many labels. There are income funds, comprised mostly of bonds usually, and high-yielding dividend-y kind of stocks. And you can buy them managed, like in the form of a mutual fund, or unmanaged in the form of an index fund. There are growth and income funds, usually a combo of stocks and bonds, so in theory the fund's value grows, but it also throws off a lot of cash along the way. Then there are just growth funds. Notice the word aggressive isn't in there. On the volatility spectrum, well, they live out here, right-hand side of the bell curve. When times are good, they're very good. When times are bad, they're oh so not good. In a good year, a growth fund can be up 15, 20%, maybe more. In a bad year, well, down the same. So now tack on the word aggressive in front of that fund flavor, and you can maybe double the volatility for the good and the bad. And the high octane fund is, an allegory for gasoline on a fire. It can really roast you nicely and warmly in the cold night, or it can, well, do that. So what do aggressive growth funds like these invest in? Go aggressive. Let's go. Not just once, but twice. Well, they invest in typically risky, volatile stocks, whole lot of technology stocks that are unproven. Small tech companies are a regular favorite of this class. Is this little company the next Amazon in 20 years, or is it pisocrap.com? Well, over long periods of time and inside of bull market eras, like decades where the market generally goes up, like it has been since 2009, well, aggressive growth funds might compound at 11, 12, 13, 14, 15%, something like that, whereas a bit more conservative, just growth funds might only compound at 8, 9, or 10%. But those 2 percentage points of compounding actually matter a lot over the long run. Remember that rule of 72? Well, take the compound interest and divide it into 72, and that's how long it takes to double. Well, it applies here as well. The aggressive growth fund should, in theory anyway, add 2% in returns or reward in good times, thanks in large part to the added risk taken in that category. So 36 years pass, and that aggressive growth fund, all else being equal, should be double of what a normal growth fund should be, but with a whole lot more volatility. See that 2% divided into our little rule of 72 thing there? Well, that's 36 years to double with that extra 2%. So, if you can handle the volatile, violent, flame-filled Rocky Mountain-style peaks and volatility valleys of Depression Canyon and Kill Me Now Cave, well, then you'll love the view from Everest Lookout and Punitive Taxes Peak if you're an investor, like the wealthy, in aggressive go high-octane funds. Yeah, go for it if you have the cojones.